Many workers access their retirement benefits when switching jobs, unaware of the impact it has on their future. Taking out your retirement savings too soon reduces the income you will have when you retire, leaving your future less secure. Have you thought about the lifestyle or income you want to retire with? The earlier you start saving, the better. And the more you save, the more secure your future will be. Increase your savings today and live your golden years the way you've always dreamed. For more information, visit our website www.rba.go.ke, call our toll-free line 0800-720-300 or email info@rba.go.ke. Secure your future. Secure your peace of mind. RBA, safeguarding your retirement benefits.
Okay, so we are going to start this second session. We have been given the blessings of the CEO, who is still handling some media engagements. And therefore, they shall join us as we progress. This session is a tax sensitization session. And its genesis are the Tax Law Amendment Act of 2024. The retirement benefit sector received the Tax Law Amendment Act 2024 with excitement because of its provisions. Good provisions that have been alluded to this morning by our various speakers. While we are still on cloud 9, it is important that we take this opportunity, whilst we're still excited, to appreciate how to implement these provisions correctly. It is therefore my esteemed pleasure to welcome officers representing the Kenya Revenue Authority to this particular forum, to shed light on these provisions so that we, as service providers, particularly the administrators who handle the day-to-day aspects of benefit calculations, tax calculations where applicable, and the remittance of that taxation, are able to gain clarity and go and implement and serve the industry that we so dear love. So in this regard, I would like to welcome the representative of the Commissioner General of Kenya Revenue Authority. He is represented here by Ms. Betty Kimeo, who is the Chief Manager, Compensation and Benefits at KRA. Ladies and gentlemen, let's give her a round of applause as she comes to the front.
Good afternoon. I will start by giving remarks from our Commissioner General and to the Permanent Secretary, National Treasury, Dr. Chris Crypto in absentia, the Chair and Board of Directors of the Retirement Benefits Authority, industry stakeholders, other partners in the pension space. Ladies and gentlemen, good afternoon. My name is Betty Kimeo, and I'm representing the Commissioner General, Kenya Revenue Authority. And it's our pleasure to be in this forum as partners with RBA in ensuring that our retirees enjoy a befitting life after they exit formal employment. I know it's the RBA's desire that the same way you are living, the same benefits you're enjoying when you are working, is the same lifestyle you will almost transition into when you retire. And that's where we come in as KRA to partner with them in terms of laws. Just a brief, Kenya Revenue Authority was established by an Act of Parliament, Chapter 469 of the Laws of Kenya, and this became effective on the 1st of July 1995. KRA has 3 core mandates as an authority. our role anchors on the following issues: to assess, collect, and account for all revenues in accordance with the written laws and specified provisions of the written laws. We also have a mandate to advise on matters relating to administration and collection of revenue under the written laws or specified provisions of the written laws. We also have a mandate to perform other roles that may be given to us from time to time from our parent ministry, which is the National Treasury, to perform. So with specific reasons why we are here as KRA and partnering with RBA today is with the support of government. We've had various revisions of the Income Tax Act. Basically, this forum touches on one of the acts, which is the Income Tax Act. And for us, we've had several amendments, and the most recent one is one that happened, we've all been talking about the 2024 Act, 2024 Amendment, which specifically now exempts pension schemes and income and benefit from tax, which has been applauded by all our speakers who've come before us, and it's a good thing. And to further this conversation and to just explain it further and to deep dive into it and to give the provisions that have gone into it with clarity where clarity has not been brought out in the act as it was written, I want to take this opportunity to invite my colleagues who will take us through a presentation that we have prepared that gives us a deeper understanding of the pension space with regards to tax matters. In this, oh, that's not working. Okay, thank you. Sorry for that. In this regard, I want to invite two of my colleagues, Mr. Julius Yeager and Mr. Isaac Ware, who will come and give us a presentation with regards to the pension scheme and the space that we are in. After that, I think we'll have question and answers and clarity sought on areas that need to be clarified. Thank you very much.
Good afternoon, ladies and gentlemen. Allow me to start by saying that this is a good day, and we want that when you go back from today, go tell everyone that KRA is one of the best institutions that you have in this country. I can confirm that. I've been there for 30 good years, and I can tell you that I'm now conflicted because I have a very few months and I'll be a retiree. And that is why today I decided to come with my good friend who has been working with me all along, Isaac, and I've promised that Isaac will answer almost all questions, because me, when I'll be responding, I may respond so anyway, Julius Yeager is my name, and as we said, please, but I want to stress something, that this is the time when proposals are being given, and so there are a lot of things that you, as the people who are managing them, all those questions that you are asking for, all those issues that you'd want KRA to implement, it is you to give the proposals. Committee of experts. No, we won't kill them there because they will have come from you. So what we are saying is that let us KRA get as much proposals as is possible from you people. At the same time, ensure that you do what we call, you attend public what? Participation. It is important. Because you see, once it has gone into parliament and it is enacted, for us as KRA, we will collect, and you've heard our boss saying, as per the written law. So if the law is written that even me, I will tax myself to the end, I will just do that. But it's you people as the stakeholders to make it work for us. So without saying so much, allow me to just ask my colleague to talk briefly.
Thank you so much, Yeager. My name is Isaac Kweyu, as you've heard from KRA, from a division called Policy and Tax Advisory. And today we want to talk matters taxation of retirement benefits. And I don't know whether that's an appropriate title, because earlier on we were just talking about exemption, exemption, exemption. So is there still an aspect of taxation of the retirement benefits? Anyway, we'll find out. And when you are having tea, I was being told, unaona watu wote wako hapa hivi, kuna kitu moja wanataka kusikia. Now, I don't know what that kitu moja that you'd want to hear, but allow us just to go through a presentation, just an overview of the taxation of the retirement benefits. Things that you know about. We just want to refresh things that perhaps maybe are not very clear. We want to clarify. Then perhaps we'll talk about that kitu moja that perhaps has brought us here. Yeah, because I understand why. Because tomorrow is a due date, and it's important that it's clear. It's clear that we go back with an answer, and hope we'll be able to go back with an answer. I hope so. Yeah, we'll be able. Okay, thank you.
I just forgot to remind us, you are aware that 30th June is approaching, and you know that it's our Kenyan behavior to wait until the last minute. Yeah, so let's be reminded that please file your returns. Are we together up to that point? Please file your returns. It is important. I know you're very weak with the deadlines, but please remember, if you can forget so much, but don't forget to file your returns. And then also take advantage of the tax amnesty. Tuko pamoja up to that point? Yes, please take advantage of that. It is very, very important that that is done. Isaac, I'll hand over to you because I'm almost getting conflicted. Allow me to also behave and hope that when I retire, I will still be earning the same amount I'm earning now. Thank you.
Thank you, Yega. And thank you so much, RBA, CEO in absentia, and the entire team for inviting us for this particular engagement. Indeed, we are honored just to be part of this. We do appreciate. We'll go straight to what we have for today, just a brief overview of the taxation of retirement benefits. And we just want to appreciate the feedback that you also get from the industry and the proposal that we made. At times, it's not just the industry that is happy about the proposals that came through in December. We also happy because you're also taxpayers. Somebody was asking, "Nyi watu wa KRA mnalipa kodi?" Yeah, we are the first ones actually to pay. Yeah, before you remit, we'll have remitted ours before. Yeah, so we also taxpayers, and at some point we'll also retire. We're also members of retirement benefit schemes, and so these proposals that came through are very much welcome. We hope to get more, even as time goes by. No, we just want to look at an aspect of registration, and I think the CEO captured it very well. He actually summarized what we're going to go through briefly before you have a Q&A. He talked about registration, talked about the allowable contribution, then there's the aspect of the excess contribution and the allowable limits. I think that's where there's a bit of an issue that we'll need to discuss further. The taxation of pension income. We are talking about exemption, yet here I'm talking about taxation. So how does it come about? Transfer of funds, yeah, the law, one can move from one scheme to another. So what is the tax implication to that? Then you look at applicable tax rate. Yes, we are talking about exemption, yet here is applicable taxes. So when do these tax rates apply? Then any tax compliance issues that may arise. So it will just be a very brief presentation. Now, when it comes to registration of retirement benefit schemes, a very welcome amendment in law. Previously, you'd register with RBA so as to operate as a retirement benefit scheme, then register with KRA for purposes of exemption. But now that has been done away with. There's no more registration with the Commissioner for purposes of tax exemption. In as long as you are registered with the RBA, just as the CEO said, very clearly, that amounts to a tax exemption in itself. Apart from the fact that you've been registered to operate as a retirement benefit scheme, then you also qualify for exemption. So the issue is, how do you operationalize this? That has been the main issue, and we've started engagement. I can confirm this with RBA on how we can go about operationalizing this tax exemption. Previously, a retirement benefit scheme will file a return, and it will capture its exemption certificate. To that extent, that income will not be subject to tax. However, Now we have now an RBA certificate that is also an exemption certificate. So how does how does ITAX recognize and the RBA certificate for purposes of exemption? So that we're in the process of now operationalizing that, such that now if for existing schemes that already have exemption certificates, going forward, how do you operate? Because previously you'd have to capture exemption certificate, in that return, so that the system does not tax the income that you declare. But now that we are doing away with the exemption certificate, we'd want to transition. How about new schemes? A new scheme that is being registered. And it has it's been registered by RBA, meaning that it's already exempt. So, we need that smooth transition, such that now you're registered with RBA, then we need to recognize that tax exemption automatically. So we're talking about aspects of integration, RBA and KRA, such that once RBA registered, it's recognized. You have a PIN, you have a RBA registration certificate, then you are recognized as an exempt entity, and so on and so forth. So, and we're talking about exemption. You're not exempted from declaring, you're not exempted from filing a return, but exemption is on paying on tax, isn't it? Hope that is clear. You're expected to declare that income, however much, however little, you're expected to declare. However, the exemption is on payment of tax. Just moving on quickly, the aspect of allowable deduction, yes, it was increased from 20 to 30. Some people are saying, your burden is kidogo, but at least it's something. But I agree, perhaps it should have been higher. Now the allowable limit is 30,000 per month, or 360,000 per year. So if you earn 100,000 shillings, you deduct 30,000, 70,000 shillings will be the taxable income. However, there's a rider to it that this one is also available. This one is to be shared between the employer and the employee. However, who is the beneficiary of the scheme is the employee, isn't it? So the employee tax priority, if the employee is contributing 30,000 shillings, there's nothing left for the employer to deduct. However, if the employer is contributing 15, employees contributing 15, then 15 will be allowable on the employee, and also on the taxable income of the employer, 15,000 will be allowed. Hope that we're just refreshing, in as far as these deductions are concerned. I didn't capture the aspect of post-retirement medical scheme. If you contribute up to a maximum of 50,000, is also a tax deductible contribution. Very welcome amendments in the law. Now, another issue that has been debatable, although the law is clear, there's the issue of contribution paid by a non-taxable employer. Maybe if you're paying to an unregistered scheme, I think that issue of unregistered scheme now has been overtaken by events. Now, I don't think a scheme can operate without being registered by RBA. But previously, the law provided for in case, a scheme is unregistered, in as long as it's not been registered with the commissioner. So in case an employer is contributing to an unregistered scheme, then there's the aspect of excess contribution, paid to a registered scheme. Then the law provides that it will be an employment benefit chargeable to tax on an employee. Just to break it down, that, if we talked about a limit of 30,000 shillings, if an employer has contributed 30,000 shillings, and an employer is contributing also 30. So this 30,000 is excess, isn't it? Yeah, because the limit is 30, isn't it? 30 per month. But the employer is also contributing for you 30,000 shillings. So that 30,000 shillings is an excess contribution. So if this employer is a taxable entity, let's give an example of Safaricom, then that 30,000 shillings will be disallowed on the employer. Yeah, it will be taxed on the employer. And the 30 will be allowed on you since you've contributed up to a limit. However, if this employer is a tax-exempt entity, is not an employer subject to tax. Like, for example, we have RBA in the house. Let's say it's RBA. It's not a tax-paying entity. So an employee of RBA has contributed 30,000 shillings, and RBA has contributed 30. So the law provides that this 30,000 shillings, the burden has to fall somewhere. In a case of a taxable employer, the employer will pay that tax on it. But in the case of a non-taxable employer, these 30,000 shillings will be added back on the employee. It will be treated as a taxable benefit. That's what we are talking about here. Any excess contribution, excess above 30,000 shillings, will now be considered. It will be considered a taxable benefit to the employee. So basically, that's what we are talking about. Sorry, I don't know what has happened. Okay, I think we are on. Just a simple illustration here. Somebody is earning 250,000 shillings, and he contributes 25,000 shillings to a registered retirement benefit scheme, and also the employer is contributing the same amount. So this is what you're saying. If the employer is a tax-exempt employer, the employee will be allowed the 25,000 shillings. Then we still have a buffer of 5,000 shillings. Then the excess amount in this case will be 20,000 shillings, will be added back to the employee. Hope that is clear. So you can just do some quick computation, and if you get a taxable income of around 245,000 in this particular example, then I think you have your computation is in accordance with the law. So what you're saying is that for a tax-exempt employee or employer, any excess contribution will be treated as a tax benefit to the employee, and it was said that this is unfair because why are we discriminating? Why am I being taxed just because my employer is tax exempt? Yeah, we are two employees here. One is working for a taxable employer, another one is working for another employer who is not subject to tax. So why am I being disadvantaged for tax purposes just because I'm working for a tax exempt employer? So there are proposals that stakeholders, the forwarding proposals so that now to do away with this aspect of the perceived discrimination here, because ideally the aspect of equity is not being, as far as they're concerned, this law is not equitable because we should be treated equally as employees. An employee working for RBA should not be disadvantaged just because the employer is a tax exempt. Hope that issue is clear. Just another example that just to bring out this aspect also. This particular person earns 200,000 per month and he contributes 30,000 to a registered scheme, but the employer is chargeable to tax. So in this particular case, if the employer is chargeable to tax, the taxable income, if you do your math here, the taxable income will come to around 170,000 because that which the employer is contributing, since he's a taxable employer, will be taxed on the employer. So hope that is clear. Let me not belabor so much on that. Now, there is the issue of transfer of gratuity. Yeah, there's a transfer of gratuity. There are those who are on contract and periodically, they are paid gratuity. But you decide that you don't want to receive that particular amount, you don't want to transfer to a registered scheme. So the law provides that if you transfer 360,000 per annum, then that particular amount will be tax-free. There's been a debate that, that 360 hiyo ni kidogo sana, perhaps it needs to be reviewed, but at least it's something. 360,000 per year. If you transfer to a scheme, then you'll not be subject to tax. However, just a rider on this, in case you've already enjoyed a deduction, perhaps you've been enjoying a deduction up to 30,000 shillings per month, and you get a gratuity after a certain period, and you don't want to transfer to a retirement benefit scheme. Now, you see, you've already enjoyed a deduction of 30,000 shillings per month. So this benefit will not be available for you. This benefit will only be available in as long as you've not enjoyed the deduction. But if you've already enjoyed a deduction and you don't want to transfer your gratuity to a retirement benefit scheme, then it will not be available. However, if you've not exhausted the deduction, then that portion that has not been exhausted will be available for you for transfer. Glad that most of you are, all of us, or rather most of us are practitioners, so you appreciate what we are talking about when it comes to transfer of gratuity. I know there's been also, after the Tax Law Amendment Act, there's been the issue, is gratuity also exempt? And I think it was mentioned earlier in the morning session. We're going to talk about that later on. But this one, we're just talking about transfer of gratuity to a registered retirement benefit scheme. Now, this I've just recasted what was provided for in the Tax Law Amendment Act. Now, income of retirement benefit schemes, this is what we've been talking about. They are tax exempt. Yeah, in as long as, it's a pension scheme, a trust scheme, pension fund, provident fund, an annuity fund, under the, as defined in law, then all that income, you've invested in treasury bills, you've invested at the stock exchange, you've invested in real estate, all that, beginning 27th of December 20. It's been there in law. I'm just we're just combining the new provisions that came through in December 2024 together with what was in law. This one has been there for some time. Although now this has been a contention because in as far as the commissioner is concerned, there's a portion of the income that schemes have been paying corporation tax, and I suspect that's why somebody was saying, you metuleta hapa. So we'll discuss that. Yeah, the law is very clear, just a very brief provision in law that income, a registered pension scheme, trust fund, pension fund, all that is exempt. That is what the law says. However, there's a portion of that income that the commission has been subjecting to tax, and there's been dispute, and the Tax Appeals Tribunal made a verdict. It made a decision. It passed. It ruled that the schemes are right, that this income is not supposed to be subject to tax. But we'll discuss the details to it towards the end of this presentation. Chair, how comes I continue? There's something I've missed out, or? Okay, then we'll carry on. We'll carry on. I think I need a helmet now. I tell you. Okay. Now. Okay. Now, pension income. Now, when it comes to pension, just for clarity, just to remind ourselves, there's been a debate: is pension income, is pension a saving? And it's good that now we are talking about exemption of pension income, because even previously there was a debate: is it an income? I'm saving for my retirement. Then when I'm being paid that money, why is it being treated as income? Anyway, the point is that when a resident individual receives income from a pension fund or a pension scheme, that is deemed to be income derived here in Kenya, because it relates to employment services that you rendered here in Kenya. So in case somebody has rendered services here in Kenya, even if is contributing to a scheme outside the country, perhaps you are working for an international organization, and according to the perhaps the policies of the company, you are required to join a scheme that is registered outside. Now the law provides that, that the pension income that you're going to receive from that scheme, in as much as that it's registered outside the country, the services were offered here in Kenya. The employment services were offered here in Kenya. So when you receive that income, that pension income, it will be subject to tax here in Kenya because services were rendered here. The same thing, even if it's a non-resident, somebody is working outside the country and receiving pension from a scheme here in Kenya. Yeah, the law says that in as long as that scheme is registered here and it's paying, in as much as it's paying somebody outside, then that income is deemed to be derived here in Kenya. Basically, the gist of it, the general rule of taxation in Kenya is that what is taxable here in Kenya is what has been derived. But at the same time, their incomes are deemed to have been derived in Kenya, in as much as perhaps it's being paid from outside. Such is an example of, you're receiving pension from outside the country, but you offer the services here in Kenya. So in that case, it will be taxable here in Kenya. Now, this what was the amendment that was brought about in the Tax Law Amendment Act 2024, that pension benefits. And another question that has come up so many times, and we say, about income drawdown. We say that in as long as it's a pension benefit, be it in form of an annuity, be it in form of an income drawdown, but it's being paid from a registered pension fund, a provident fund, from NSSF, perhaps you have an IPP, an individual pension fund, then it qualifies for exemption. In as long as you met the requirements for retirement, you're a member of the scheme and you have retired in accordance with those rules of the scheme. You know, there's an issue, can somebody be paid at the age of 50? Should that person wait until he's 60? If the rules provide, you know, there's an early retirement scheme, there's an early retirement arrangement, there's a normal retirement arrangement, you know, those are the rules of the scheme. And as long as you met those rules and you're being paid your retirement benefits, then you qualify for this exemption. At least that has been the commissioner's understanding, that the condition is, and that's what the law provides, that you've met the requirements for retirement. Then to that extent, then you qualify. You qualify for exemption. Then besides having met the requirements of the scheme to retire, then we also have this one. If you are being paid a gratuity, I think this is where there's been a debate also. If you are being paid a gratuity or other allowances, also that other allowances has been a big question. Paid under a public pension scheme, then also that one is tax exempt. And a public pension scheme is what is a scheme, it's funds being paid from the consolidated fund. That's at least what the income tax defines what a public pension scheme is. You know, money is being paid, or pensions or lump sum being paid out of the consolidated fund. Yes, it's been deemed discriminatory. How comes an employee, receiving a gratuity, from, a private scheme? How come they are paying tax, yet somebody else receiving a gratuity from a public pension scheme, which is basically the consolidated fund? How come it's being exempted from tax? Anyway, that's what the law provides, and the commissioner will implement as it is. So for those of us who are receiving gratuity, unless you are receiving from this scheme, then that gratuity will be subject to tax. Hope hapo tuko pamoja. Unless now you're transferring that amount to a registered pension scheme, as you had looked at earlier. So as it is now, according to the wording of the law, gratuity is subject to tax. However, gratuity from this scheme is not. Then there's the aspect of payment of a returning annuity of perhaps maybe you are retiring due to ill health. Perhaps you've not met the conditions for retirement, but due to ill health, you are retiring. And I'd want to bring in what my friend Anthony brought out, the aspect of somebody who the unfortunate has happened and somebody has passed on. So our understanding has been that if you're being exempted for, if your income is being, you're withdrawing from a scheme due to ill health, then the worst has happened. I don't think it makes sense for you to be taxed. Yeah, for you to be taxed having passed on, yet you are being exempted when you are ill. So, our understanding is that it therefore follows that, if somebody passes on and the retirement benefits are being paid to the beneficiaries, then that income should not be subject to tax. And there's a slide that will explain further on that one. Then there's a withdrawal after 20 years. That's another condition. These are standalone conditions. In as long as you've been in a scheme for 20 years and you want to withdraw, you joined a scheme at 20 years, and at 40 you want to withdraw. Yeah, we'll not say huyo ni mdogo sana ati bado hajafikisha miaka. He's been in the scheme for 20 years. Yeah, perhaps he's in the armed forces, he joined early, and he's been in the scheme for 20 years. In as long as he's attained that criteria, it's a standalone criteria. You've been there for 20 years, then you qualify. You qualify for tax exemption. Perhaps he's a sports person. Yeah, he's an athlete. He got an IPP. He joined. He has an independent, scheme, individual scheme, and he's been there from when he started perhaps his career, and he's retiring at perhaps at 39, at 38, and he's been there for 20 years. Then he qualifies. He qualifies for exemption because he has met the 20-year requirement. And there are these situations whereby one may move from one scheme to another for certain reasons. Perhaps you've changed employers. Perhaps you've decided maybe another scheme is better. I don't know whether there are schemes that are better than others, but you'd want to move to another scheme. So our understanding is that, the 20 years are cumulative. You've been in a scheme for 5 years, another scheme for 10 years. As long as those schemes are registered, yeah, in as long as you've been in a registered scheme. But again, as we said earlier, the aspect of registration. In that case, then it's exempt. However, if it's being paid to an estate of the deceased, it's only the first 1.4 million shillings that will be tax exempt. Now, the aspect of that person who's not met the condition, he's not been in the scheme for 20 years. Someone has not been in the scheme for 20 years. Perhaps you're withdrawing, not because of ill health, and so on and so forth. Then that person will be subject to tax. And these are basically the individual tax rate, the taxes that you and me pay, the rates of taxes that apply to our income, be it employment income, be it business income, be it rental income. That person who's not met the conditions will be taxed in this manner. However, there are tax-free amounts that are still provided for in law. Prior to the Tax Law Amendment Act 2024, when pension income was subject to tax, not the whole amount was being subjected to tax. Though, the law talked about the first 600,000. If you're receiving a lump sum of 1 million shillings, the first 600,000 was tax-free. Then the 400 will be subjected to tax at wider bands. Now, those wider bands, we no longer have them because pension income is tax-free, isn't it? Now, but we still have these bands for let me call them the normal bands that apply to any other individual income. So in that case, if a member has not met the condition and is leaving for certain reasons, is withdrawing from a scheme, then these rates will apply. However, the tax-free amount he'll still enjoy. You don't tax him from zero. If somebody is getting 1 million shillings, yet he's not met the conditions. And that's why I was asking, this, by the fact that somebody is leaving employment earlier, does it recharacterize? Does it change the nature of income? It's still pension income, isn't it? In as much as he's leaving early, it's a saving that he had made with the scheme. And he's getting these funds from the registered scheme. So it still remains pension income. He's still withdrawing from a registered pension scheme. In that case, that person, he or she will enjoy the tax-free limits. And currently it's 600,000. Perhaps we need to put in proposals to increase that amount again, isn't it? Yeah, 600 perhaps, hiyo ni ya kitambo kidogo. Anyway, yeah, so you don't tax the whole amount, you grant him the excess, the tax-free amount, then any excess amount will be taxed in this manner, and it's a final tax. A final tax, by this we mean he doesn't need to declare. He doesn't need to declare at the end of the year. However, if somebody has other sources, that is expected to declare. But in as far as pension income is concerned, then they are not supposed to declare. So I don't know if you require perhaps there are those who have not listened to anything. They are just waiting for this one. Yeah, I want to pray for grace. Anyway, now, corporation tax. Corporation tax. This is another issue that compliance issues that may arise to the scheme. As we said, income of a retirement benefit scheme is tax exempt. That's what the law says. Income of a retirement benefit scheme is tax exempt. However, corporation tax aspects may arise in case a scheme was not registered, because the law provides that the exemption is on a registered retirement benefit scheme. But where a scheme is not registered, then that one is subjected to tax. But again, we say the issue of registration now has been addressed in law. The RBA will register the scheme, so the aspect of a scheme not registered may not apply. Now, secondly, there was the issue of income of a scheme that is attributable to the excess contribution. We say the contribution is up to 30,000 shillings. However, you can contribute in excess of the 30,000 shillings. So the commissioner's treatment or understanding of that excess contribution is that any income that has accrued, has been earned by the scheme from that excess contribution was being subjected to corporation tax. And as we are all aware, on 30th of August last year, the Tax Appeal Tribunal made a ruling to the case of Benki Kuu, the scheme of the Central Bank of Retirement Benefits, Staff Retirement Benefit Scheme, versus the commissioner. There was a dispute, and the TAT ruled in favor of the scheme. In other words, the whole income of a retirement benefit scheme is exempt, because that's what the law provides. It does not say a portion of it is taxable and a portion of it is exempt. It's the whole income, and that's what the TAT ruled. And that binds the commissioner by the same. However, I understand there have been communications. Yeah, we've received a communication that the commissioner has appealed against this ruling, and that yes, another question: where is the stay? Yeah, there are discussions going on this particular case. But I know the pressing issue tomorrow is a due date of installment taxes, and the cue I got is that now we need direction in as far as installment taxes are concerned. Should the schemes pay installment taxes, by tomorrow? Yet the TAT ruled, that these incomes are not subject to tax, despite the commissioner treating it differently. Then another question has also come up: will the commissioner refund? Will the commissioner refund? Were these taxes paid erroneously? Were they paid erroneously all these years? And should you continue paying on the same? Now, we had discussions on this. Since you already have, number one, let me say two things about this. a number of schemes have received letters that they are required to pay installment taxes by tomorrow, isn't it? Yeah, I would request that, I don't know how many have responded to those communications. It's important. Yeah, it's important that I don't respond verbally to a written communication, isn't it? It's good that you also respond to the letter. So I would want to encourage all of us, those who've received, please respond, and by response you mean your understanding and your position to the same. You know. Or you wanted to respond differently? Yes, that's what I'm saying. Two things. Number one, I would request, or rather, I would urge us to respond. Those of us who received the letters, to respond on the same. Number two, on the aspect of installment tax that is due tomorrow, I would want, you know, it's a self-assessment regime, isn't it? We in a self-assessment regime where you make a determination of what is payable, and you declare. You know, the position is this, that the commissioner is considering an appeal to this. Now, if the appeal goes in favor of the commissioner, and perhaps you've not paid those installment taxes, and you'll be required to pay at a later date, and it will be accompanied by interest and penalties, isn't it? No, I'm just saying. No. I'm just saying. No, I'm just saying in case an appeal is a successful appeal. In case it's a successful appeal, yeah, we start for okay. Yeah, there are also all those views. But I'm just giving a view that a plausible view. It's possible that it might be accompanied by interest and penalties. Yeah. Yes. Okay. Yeah, it's true that it cannot be retrogressive. And lawyers are here. A former chairman of LSK is also here. Chair. Yeah. So allow me just to on this particular issue. Yes, it's a sensitive issue. It's a hot issue. It's an issue that, as I was told, you and you met later up. I would want us to respond to the letters that you've received. Number two, this is the ruling that the TAT made, that those incomes are not subject to tax. Number three, we are in a self-assessment regime, isn't it? We're in a self-assessment regime. And you're expected to declare and assess yourself. And the TAT made a ruling, isn't it? That income is not subject to tax. However, the commissioner is still fighting. Commissioner still wants to collect taxes on the same, not really fighting. Commissioner is still of the view that part of that income is still subject to tax. So it's still a fluid issue. It's still a contentious issue. So I would urge us that yes, an appeal may be an impending appeal, and in case the appeal succeeds, there's a possibility that you'll be required to pay that installment taxes together with some penalties, isn't it? The courts will direct accordingly. Sir. Okay, fine, okay. So hope that matter can rest there. Okay. What we'll do on this particular matter, we'll get before end of the session. We'll come back to you, a final direction. Given that now tomorrow is a due date, I think it's very, very important that the commissioner guides on this. But again, let's remember it's a self-assessment regime, isn't it? Isn't it? Yes. Yes, Chair.
What you're saying, know, when the matter has been decided, there is a timeline for appeal, and we don't want you to look like you're being unduly oppressive. So if you can address the matter, this is an engagement with with your customers.
Okay.
So the members are saying, go and try another route.
Okay. Thank you, CEO. Very valid comment. Yeah, there are timelines within which we can lodge an appeal, and as it is, yes, the ruling was made last year in August, and April the following year. Surely we are way outside, out of time. Can you rest it at that? But we'll come back. Sorry. Thank you. Please allow us to raise it at that point, but we'll come with the final direction before the end of the session. Yeah, we'll come with the final direction. But let me say, we've had engagements on the same with RBA, and they can confirm that we had very good engagement. I believe the engagements we had with RBA, the CA can confirm that they were good engagements, and we actually gave up a position on this, but there's been a review on the same. Yeah, there's been a review on the same. Yeah, so we'll come back to you on the same. Yeah. Yeah. Sure, I agree. The policy direction that the government is taking is exempt, and it appears this direction is contrary to that particular position. That's what we're saying. Allow us, just before we end the session, at least we come with a position. In view of the fact that tomorrow is a due date, or a due date that never was, isn't it? Yeah. So then there's the aspect of corporation tax on the sponsor, that is the employer. Yeah.
So let me bring you the microphone.
So what I wanted to say is that, could you just go back on that slide? The people seated here don't carry that money for themselves. They hold that money on behalf of the members who are actually not here. So assuming we pay tomorrow, and we hear your non-commitment loud and clear on this issue. So assuming we go ahead and pay, and the members sue us, who are seated here, for going against that, especially in a position where there is no stay. So we need to, and also assuming you don't get back to us before the end of the day. So what do we tell those members? And we would request that you actually come out clear on this issue, kindly.
Thank you, Ofubwa. True, we need to confirm Commissioner's position on this particular matter, and we made a commitment that we'll do so before the end of the session. That we promise. Yeah. Thank you. Another corporation tax aspect is on the sponsor. I think we are done with the scheme. Where a contribution are being made to an unregistered scheme, but again, that has been addressed by law. The situations of unregistered scheme may not arise. Then contributions to a registered scheme, but in excess of the limits. Again, that we have talked about, it will be added back. If the sponsor, if the employer is a taxable employer, then those excesses or a contribution to an unregistered scheme, it will be taxable on the employer. But again, you also talk about situations where it will also be taxable on the employee, where the employer is tax exempt. Then Other tax compliance issues that may arise to a scheme is pay as you earn. Schemes of employees, isn't it? Yeah, so where we have contribution to unregistered scheme, again, that has been overtaken by law. Pay as you earn will apply. Excess contributions, pay as you earn may apply. If it's a contribution on behalf of the employee to unregistered scheme, pay as you earn may arise. Then the aspect of a tax exempt employer making excess contributions, then it's a benefit to the employee, and tax pay as you earn will arise. Even as we bring this to an end, there's aspect of withholding tax provisions. Then when it comes to withholding tax, where a member has not met the conditions, and we looked at those conditions, just basically the difference between pay as you earn and withholding. They have different due dates. When it comes to withholding, in case you're withholding tax on a member who's not met the conditions, the tax will be in form of withholding tax and needs to be paid within 5 days. Pay as you earn, we know it's paid by the 9th of the following month. So just to remind ourselves that pension income or tax on retirement benefits are governed under the withholding tax provisions, so they need to be remitted within 5 days. Then actuarial surpluses that are paid to the employer, they are paid to the sponsor, then they'll suffer corporation tax at 30%. So, and again, if you're paying schemes, you're paying professional schemes of engaged a lawyer, an accountant, auditors, actuaries, custodians, if you any fee payable to them will be subject to tax, withholding tax of 5%. And of course, that is not a final tax. The recipients of that money are expected to declare. Then finally, there's VAT schemes, schemes that have a commercial building. A commercial building is a taxable supply. So if a scheme has a commercial building, they're expected to register for VAT and declare the same. VAT is a consumption tax. It's basically the tenants who are expected to pay. You'll be charging those tenants VAT and remitting to the commissioner. You're basically an agent acting on behalf of the commissioner. So one is required to register for VAT in as far as commercial buildings are concerned. So I think that brings us to the end of our presentation. Yes. Yeah, I'm not being appreciated, so I think.
Thank you, Isaac. I always don't leave him behind. We always go together. And let me tell you, you've done your best. These are Kenyans, and you understand that Kenyans are very good taxpayers. That much we know. But at the same time, we want you to appreciate the mandate of Kenya Revenue Authority. Our mandate is very clear. Last but not least, if any institution has received a letter from a commissioner of tax, please respond as an institution to the letter from the commissioner. Did you get that? Luckily, we're in the house with Nelson Havi. I've never seen him live. I've seen him today. So he understands that better than I do. That once you've received a letter from Commissioner of Tax, please respond to the letter. Because in this forum, we are expected, and you remember my boss, Representative of the CG, said that whatever we tell you here is per the written law. So please, as a good country, good citizens, that is what it is. So those of you who might have received that letter yesterday, I know you are here. Please respond to the letter. What will come thereafter will be sorted out based on what will come out in the ruling. Tumeelewana vizuri? Yes. So I think that rests that matter. So Isaac, I think you've done well. The other one is that I want you to ask Isaac as many questions as possible with regards to what he has covered. So let nobody say that we came and didn't get it, because there's a possibility that most of you will only remember the last argument. At the corporation what? Tax and the installment. Remember the good things that we have given. So are we okay up to that point? Yeah. And please advise your customers accordingly so that they can know. I realized that even us today when we came in, even me, I didn't know some bits until I was told that if I'm going home in a few months' time, A lady seated there guided me that I can still let my pension rest there for 1 year before I take it, or before I start earning pension. Is that true? Now, so when you're in a forum like this one, don't just be looking at KRA. Even you now share ideas with us, so that by the time we are going back, we give you the right clients. Are we okay up to that point? Any other questions for Isaac? Because for me, I'm almost conflicted. Even this morning, somebody told me, please get up from this chair. This chair is meant for the elderly. And yet I have a letter of retirement. So I was wondering, when will I become elderly? Okay. Yeah, so any other questions, please, so that we can handle them? Can we have the microphone, Care? Yeah, there are a few hands there. Isaac, you are the youngest. You stay here. You don't go anywhere. Hmm?
So we'll take questions in groups of 5. So let me start off with this side, as I'm on this side, and then we'll come over to that other side. As you ask your question, just identify yourself and your organization.
Good afternoon. I'm Edwin Mutambi from CPF. My question will touch on gratuity. What is your take on gratuity taxation? Or is it supposed to be taxed at source or supposed to be taxed at payment point? Because there is provision of gratuity to be converted to pension. That is one. Number 2, when you are taxing gratuity at payment, will we apply the tax burdens that you have provided there of 0 to 288,000, or we refer to the 0 to 400,000 tax burden?
Good afternoon. My name is Daniel Odiabo from Jubilee Life. I'm asking about the letters that you are saying we need to respond to. What if other schemes didn't get the letters? What do we do at that moment? Thank you.
Third question still on this table.
Yes, good afternoon. My name is Michael Kirui. I work with Liaison Financial Services. Now, my question is on the taxation of benefits for people who have been in the scheme for 15 years. Remembering that or considering that initially, for members who are in the scheme for more than 15 years, we were using the wider band in taxation. What happens? Has that one be done away with? Thank you.
2 more questions from this side.
My name is Dan Okini from Kenbright. Thank you for your presentation. There is something that is not clear on service, accumulated service. Let's say somebody from scheme A to scheme B, then what you have said is you can accumulate the years of service. So what happens if somebody is a member of more than one scheme? Because somebody can be contributing for more than one scheme. Then number 2, with almost the same, is when you talk about being present, do you mean active, that is a contributor or a dormant member? Then number 2 is, maybe you can just clarify on the narrow tax band. Did the amendment only affect the payee, or it also affected the payment of the computation of benefits? Then lastly, I'll just bring you back to corporational tax. My understanding on if there is a ruling, a window period between a ruling and the final of appeal is this, and in the absence of a stay order, that I believe the ruling should take precedence. So maybe as you prepare to give us your final input, maybe you may need to clarify on that, on the position. Yeah.
All right. And the fifth one here.
Okay, thank you, Isaac. My name is Christopher Losialoi from Kenya. I want to revisit the debt benefit. Now that you've mentioned all through that the law says, now that the law is not very clear, can you make that clear in this finance bill that the debt benefits are included? Because tomorrow if I come to KRA, maybe I may not find an Isaac, and there's somebody who will ask me, what does the law say? Thank you.
Maybe just a rejoinder to that. So from the RBA Act, pension benefits do not form part of the estate. So we would then take it that the benefits arising from the scheme should not be part of the estate. But in your provisions, you have the 1.4 up to 1.4 exemption if the benefits are being paid to an estate of a deceased member. So I think we have an opportunity to regularize that issue. Thank you.
So let's take those first five first, and then we'll go for a second round.
Okay, thanks. Thank you. Perhaps I can start with Christopher and Wafubwa on the aspect of death benefits. You know, what does the law provide currently? And I'm glad that the PS made a commitment that when you'll be meeting the industry in May, that you are supposed to, you're required to bring up those proposals, isn't it? And one of them was the aspect of death benefits. But currently, currently there are two aspects that have been provided for in law. And basically what I said is just what is provided for in law. Number one, that if it's being paid from a registered scheme, you know, to the beneficiary, the widow, the children, then to that extent, it's as though the member is receiving, so it's exempt from tax. At least that is what is provided for. But at the same time, the law provides that if it's being paid to an estate, but you know, Afubo is saying that you know, pension benefits do not form part of an estate. Perhaps is there a conflict in law there? Is there an aspect of realignment or an amendment is required? So that's basically what the law provides, those two aspects when it comes to death. But I agree, those conditions that were brought, that came through the Tax Law Amendment Act 2024, the aspect of 20 years, the aspect of ill health, having met the conditions, annuity, I believe we needed to have included death there, so that it's very clear. Yeah, so and that's a welcome amendment, I think, so that now there's clarity in law. Hope that answers the question. There's Edwin of CPF. I think the aspect of source and payment, I didn't get out very clearly that gratuity on payment, then on source. That aspect of source, I think.
I was asking, is gratuity supposed to be taxed from the employer? What is your take on it? Does the employer has to tax gratuity before submitting to the scheme, or he can submit the scheme without gratuity to the scheme without taxing, so we can tax at payment? The unregistered part.
Okay, thank you. I think that is clearer. Now, an employer has paid gratuity and he wants to transfer to a scheme, and we say there's a portion that is tax exempt, isn't it? 360. But in case there's an amount over and above that, that should be subjected to tax, then taken to the scheme. But there's exempt amount that will be transmitted to the scheme without tax. Then there's the aspect of wider bands and narrow band that you asked. Now, we no longer have the wider bands. Yeah, the wider bands for, when pension income was subjected to tax, the wider bands, you know, in other words, you are paying at a lower rate as compared to any other income. But since pension income is exempt, then you no longer have those wider bands. And whoever is getting pension income having not met the conditions, then they'll be taxed in the normal bands that we looked at. So we no longer have the wider bands in law. Then Daniel of Jubilee, the aspect of those who did not receive. We are still going back to later. Anyway, I promise, allow me just to get back to a final answer on this, because it will affect those who got and those who did not get, isn't it? The Bible says those who came in the morning and those in the evening. Anyway, the point is this. The point is this. We're going to share. We're going to come with a final position that will apply to all. Yeah, I appreciate that those who never got those particular letters. There are those who got from a particular station. Then we have got Michael, the aspect of 15 years and the wider bands. As we said, we no longer have wider bands. The 15 years was replaced with 20. So we no longer have 15 years. So you're either in a scheme for 20 years, then you qualify. If you are below 15 years, then if you have met other conditions, then you qualify for exemption. But if you're just exiting the scheme after 15 years, then you don't enjoy exemption, unless maybe due to ill health, and you know, unless maybe you've met the retirement condition. Hope that is clear, Michael. Then there's the aspect of, you know, Dan talked about accumulated service, that you can be in a scheme to more than one scheme. That perhaps I need advice from RBA here to help me answer that question. You know, you know, I don't know, will those times count concurrently? You know, I don't know whether the law allows you to be in more than one scheme. I'm not an expert in that area. But as far as we are concerned, you're understanding you're in a scheme, in a particular scheme, one at a time. So if somebody has been in 2 schemes for 10 years, has he been in a scheme for 20 years? So your understanding, yeah. So that's what would understanding that the times do not run concurrently. Yeah, you are in one scheme, then you leave one scheme, you go to another one, isn't it? Then cumulatively, if you attain the 20 years, then you enjoy exemption. So I don't know whether you want to comment about joining 2 schemes at the same time. Perhaps RB will comment on that. Then the aspect of the stay order, I agree. There is no stay order currently on the ruling that was that the TAT made in August last year. And as I promised, we'll give a position before we leave. I think those are the questions. Yeah.
Those are the. We can take another 5 questions. Let me flow this way. So let me take a few questions here and then I'll come there.
I think mine is not so much of a question, maybe just a comment. A concern around the fact that NSSF contributions are exempt and contributions to a retirement benefit schemes are also exempt, and priority going first to the employee and then to the employer in that order. Now, because the NSSF contributions have significantly increased in recent years, we need to bear in mind that we are sharing the same exempted amount of 30,000. So as much as we are celebrating that the 30,000 has gone up, we must also be attentive to the fact that that is now going to shrink because the priority for enjoying the 30,000 first begins with NSSF, which is going up, and I think up to the 5th year, it will be quite a substantial amount. So effectively, I'm just making this observation to practitioners around here, that we need to be cognizant of the fact that we have a lower provision for exemption that we will be able to apply going forward. And I think we probably then need to perhaps lobby to see whether we can at least retain status quo, because to imagine that it is shrinking and what we are enjoying today we won't be able to enjoy next year, I don't think that is a positive thing. The second concern is around this document, the income tax cap 470. I believe this should have been overhauled a long time ago. Because if you look at this document, the changes that have been done on it, the deletions, it possibly is the most deleted, amended piece of legislation in the universe. Now, I'm saying this because I know the pain that we are talking about, the confusion around this registered and registered, came out of what we used to call a registered scheme in the past, and what we today call a registered scheme, and what was allowed in, and what was not allowed in. So we have confused ourselves because of that. I don't want to get into detail, but I just want to say, I think it's important that we get one act that reflects what we today call a tax law in Kenya. And finally, I think on the death benefit issue, we need clarity, because as we understand it as practitioners, death benefits have been taxed as if being received by the members. That is the position. The only other addition to that is 1.4 million is what is exempted if it's being paid to the estate. So we believe that death benefits should be exempted. It's the same benefit we are now exempting. It's just that somebody has died. And it's a more compelling case to exempt it. Thank you very much. Thank you.
Thank you very much. Anthony Kilavi from Zamara. So remember your name and organization.
See, before you go on, I'm getting some complaint here on gender parity,
And I've heard that the ladies' voices have not been heard in the House. There are quite a number. I think they're in this corner on my right hand. So maybe after the gentleman, I don't want to be lynched.
Okay, thank you. My name is Ayeko from Roberts Insurance Brokers. Thank you, Isaac, for the good presentation. My question was, I wanted to raise my question in regards to the corporation tax. I think what I got is that your colleague came and clarified that it has to do a letter. So I thought maybe that was the final clarification, but you've said you'll come back to us again on that one. And just to confirm, all the letters came from one station, that is east of Nairobi, and they went to specific schemes, the iTax email schemes. So my question goes to, again, the tax bans. The 400,000 bans were not deleted by Tax Amendment Act 2024. They're still there. If you look at the amendment, the 400,000 bans are still there. And again, on your presentation in regards to the lower bans, you have the 32.5 and 35%. Those ones don't affect the pension side. It's only on the pay as you earn. Okay, I think okay, that's all I have on my end. Thank you.
My name is Steve Rundu from Roberts Insurance Brokers also. I just, based on your clarification that there is no appeal, is that an admission that those letters were misrepresentative and therefore misguiding the industry?
Okay. So we are coming, ladies. I said we are coming, we are flowing that way, all right? So we'll get there. Yes.
Yeah. Isaac, we must tell you congratulations. Because we have been here in Kenya for a long time. I'm 65 years old, so I've been here for some time. But for the first time today, KRA has gone to the people to explain themselves. That is very encouraging. My name is Boniface Mwangangi. Unfortunately, I'm the Secretary General of the Association of Pension Trustees and Administrators of Kenya. I will start with the one where you are not making a commitment. In that position of your non-commitment, when we received the judgment, we analyzed it at APTAC and advised these people not to pay tax to KRA for as long as that judgment exists. Because we are aware KRA is an agency of state in this country which is bound to obey law. So much so that then when there is a judgment of whoever interprets law and the law has been interpreted in that version, if it is not changed, KRA is bound to obey. We are happy that you have now come to explain yourself without you threatening us with tax, what do they call them? Penalties. That is very pleasing, and we are happy. You can count on us for support when now you behave like citizens of the country. But now, there is a matter which I would like you to look at, Isaac. In your presentation, you have said registered retirement benefit schemes are exempted. Down on the last bullet, you have written NSSF. When the CEO of NSSF was where you were, he told us NSSF is a social security institution. From my training, of my profession, I am aware KRA is not a social security institution. It's actually a pension scheme. Yeah, NSSF, sorry, NSSF. Now, what I don't know is, why would you write registered retirement funds, then you also include NSSF down, when it itself is claiming to be a social security? Are you also excluding social security provisions, or you are excluding pension? What is it? Is KRA, is NSSF different? Different from the other pension schemes? There is then the second part of the 1.4 million shillings, which you say it's exempted, but when you pay it to an estate, some money will be taxed. My brother, we would like you to check your meanings. Estate is defined in Kenya, what it is, right? That's defined. Now, these are retirement benefits which have been exempted from taxation. And when they are being paid to the estate, it is the same benefits. At the estate, the recipients are actually the persons who otherwise would have claimed the benefits from the pension scheme. Why should you go there to tax them? There has been an argument that this 1.4 is of insured benefits. That argument has been there for some time, that it is insured benefits. But once a benefit is promised in the pension scheme, it is actually a retirement benefit, which is in the scheme. And that is written in the Retirement Benefits Act, actually. Death benefit must be provided for in every pension scheme. It is written in the Retirement Benefits Act. So when you start cutting it to 1.4 and making provision for it elsewhere, it's like there is a breach, there is a departure from the provisions of the Retirement Benefits Act, which you have accepted. We are moving towards exempt, exempt, and exempt. Probably you may wish to look at that. But there is also the matter of the 20 years, where somebody is supposed to receive a benefit free of tax. And I look at some young people who are around here. They could be in a pension scheme for 20 years and they are 49. You have a provision in the Income Tax Act which says we must not pay pension to anybody unless he is 50. You may wish to look at that one, so that when an athlete reaches 45 and he is being told he can't receive his pension before he is 50, what do you do with him for the next 5 years? And he has even retired from his profession, which is running around in Kenya and elsewhere. What do you do with that person? Probably you may wish to look at those. The last part is this one, my brother. It is important for us, like Tony says, he is a practitioner. It is good for him to know what the law is today and what it probably should be tomorrow, so that he can advise you who is waiting for a pension. The frequent amendments in the Income Tax Act, and there are many others, including the Retirement Benefits Act, they create instability in the minds of the persons who are serving the industry and those who are being served in the industry, because they can't gauge what the law would be tomorrow. Mark, as we write the laws, they are also subject to interpretation. We can try as much as it is, and that is the requirement for the Income Tax Act. Your laws must be written with clarity, not beyond doubt or beyond reasonable doubt like criminal law, no. But at least it should have a semblance that somebody can literally, in the first phase, understand it. Leave the part for interpretation to those who interpret laws. That's why we are telling you we interpreted the judgment and they gave an advisory to the industry. Thank you, and may God bless you.
Thank you very much, Mr. Mwangangi. Now I know those 4 questions have been heavy, and I've translated to another, maybe double that amount. So let's take those ones first, and then we'll come back to another round of questions. So, over to you.
Thank you, John. Begin the question by Kilavi. Not really a question, a comment, and I would agree that there is need for an overhaul of the Income Tax Act. Those are actually, there was an attempt, not really an attempt. It had actually already started the overhaul of the Income Tax Act, but it has taken longer than expected. We didn't expect it to take this long. There was a consensus, there was an agreement that actually the act is very complicated. It's been convoluted after so many amendments and so on and so forth. There's need for an overhaul, a review of the same. So it's only that it hasn't seen light of day. Hope that it will eventually come out. Then, just together with that, there was also an aspect of that as a country we need a tax policy. Again, that process had begun. There was even a draft tax policy, such that now an amendment, we will not have amendments every other year. You know, an amendment has to, we have to test, it has to be tested. You know, how is it? Not that, a law is amended this year, then the following year, it's amended again. That I agree, that creates instability, that creates uncertainty. You cannot even plan well. So, again, the aspect of the tax policy, there's a draft, but that is yet to come out. I agree the aspect of death benefits, indeed, there are compelling reasons as to why they should be expressly exempted. As it is, currently the commissioner's understanding is that now it will be exempt in as long as it's being paid from a registered scheme. But again, there have been varied interpretation to that because there isn't really an express provision on death benefits. Then there's aspect, what Ayeko said about they received letters from one station. That's why I say, allow me just to give a response that will cut across those who did not and those who received. Then we'll come back to you. Then there's the aspect of 32 and 35%. Yeah, those are the individual tax bands, and to an extent I would want to agree with you, they may not apply to exemptions, rather to pension income for those who have not met the conditions. But I'm almost certain that those wider bands were deleted. That I think I remember checking on that. Then Roberts Insurance, it's only that I didn't get the name, but from Roberts Insurance, Steve from Roberts, that is it an admission, now that there is no stay. Yeah, it's true, we have lawyers in the house, we don't have a stay in as far as the TAT ruling is concerned. But is that an admission? I agree, I've not committed, that's why I'm saying I would want to come back to you on the same. It's important that we come up with a concrete position. After all, because tomorrow is a due date, it's important that comes out. But I think Boniface has guided that you guided the members as from last year in August. Perhaps there's some installments due there were some installments due in December. There were December installment taxes, and I don't know the aspect of balance of tax not yet due, but we would want to confirm that. We want to have a firm position. But let me say this again, without just repeating myself. We had actually explained to RBA on the same, the position. But it appears it's still fluid. But we had, not really that we've changed. That's why we had actually explained very clearly, and the commissioner is bound by the ruling of the TAT. So, we promise to come back to you on the same. Then there's the aspect of NSSF and retirement benefit schemes. The law mentioned NSSF separately. I think for avoidance of doubt, yes, there's a registered retirement benefit scheme, then NSSF is also mentioned separately. And perhaps that's why you found it on the presentation as well. So just to avoid us of doubt that contributions to NSSF also, such ones also will enjoy those tax benefits. Then there's the aspect of death benefits, that needs to come out clearly, even the aspect of the 1.4 being...
When he was there, he also told us that he has exempted himself, they have exempted themselves under the NSSF Act from paying the taxes. So which act is the exempting one for purposes of taxation? Is it the NSSF Act or is it the Income Tax Act?
Okay, the law provides that tax exemption can be provided for in the Income Tax Act or any other act of Parliament. So you'll have exemptions not only in the Income Tax Act. You have exemptions, in the Privileges and Immunities Act.
Thank you.
You've got in the PFMF and so on and so forth. There's the aspect of being 20 years in a scheme, but you said something that I don't know whether somebody has seen it in law. Is there something in law that in the Income Tax Act that says you need to be 50 years? That I'm here to see it. Huh? No, okay, there was a review on the same, such that now, being in the scheme, there's somebody talked about 15 years, that was done away with, the issue of ill health. But now there's an explicit provision that in as long as you're withdrawing from a registered pension scheme, then that income is exempt from tax. You're withdrawing and you've met those conditions that we looked at. In as long as you've met those conditions, I think the aspect of 50, somebody can be 40, he's been in the scheme for 20 years. Somebody can be 40, maybe due to ill health, then he qualifies for that for that exemption. Then you talked about the frequent amendments, I agree. I agree that, that it becomes very difficult to administer the tax law, given the many amendments that come through every year.
Thank you. So the wave is coming this way. So,
Thank you, thank you. Good presentation, but as you can hear, we really have so many divergent views. My name is Daniel Mainga from Inet, Kenya, and also I sit in the Council of ARBS. So really, I've got a few comments, and one is, you can imagine the 2.25 trillion we are talking about. This room is made up of the individuals who are investing, who are administering, or even, I don't know, I don't see a custodian, but the key people who are actually handling these funds. I think it would be a bit embarrassing if we all left here today without a common ground. We do have the two authorities. In fact, even IRA was here earlier. We are saying RBA is here. We are saying KRA is here. All the practitioners who are concerned with this pension industry are all seated in this room. If we don't live here with a common position, I think it will not have achieved our goal. And I'm saying this because it's true. Majority of individuals who are here, especially the practitioners, are here because they wanted to understand the corporation tax payment because of tomorrow's deadline. I know you promised before we leave, but that promise keeps evading. Looks like it's coming at the end, and I feel like we are more or less at the end. I think we need to live here with a common position. We are paying, all of us, or we are just not paying. The issue of those letters, from where I sit, should be a non-issue. But unfortunately, when a letter is written to you, just like you rightfully said, now, there's subjectivity there. It's almost like creating fear. You had better pay, or else I had already advised you, and therefore it's up to you. You understand? So we just need to find a common position before we exit this room so that we are all very clear as an industry. Because when I look around, this is the whole industry. If there is someone outside who is not represented, I don't know which one. Because really, these are very important things. Now, I think as an industry as well, I think there's one of the slides which is a bit interesting. We are practitioners and it has looked a bit strange, the tax bans. There are so many people here, including myself, who have not seen it. The tax ban that you've just provided there. I don't know whether I'm speaking for others, yeah? Are we all very familiar with this band? Can you imagine these are the people who are paying, these are the people who are taxing? So even communication from the authority needs to be very clear and to the right people. Because this is where a few years later, you get these letters and you get to be told, please clarify, how are these payments done? And then legacy issues again come back. So I think we need to review that and look into this. Now, the last pointers are just for housekeeping, and this is in reference to, I'm just thinking aloud. With that ruling, maybe we need to go back to the policy. What is this unregistered scheme, and what is a registered scheme? Now that we'll only be focusing on registration of new pension plans with the RBA, my thoughts are, once a scheme is registered, anyone who is paying over and above the tax allowable of 30,000 or whatever amount may be in future, once you pay that as you contribute, then that scheme is fully registered. Maybe even us as practitioners, this separation of registered and unregistered should cease. I'm just thinking aloud as a policy, because once you've been exempted as a scheme, then you're in a registered fund. At the point of contribution, you contribute. If it's over and above the 30, you pay at payroll. When the funds are in the scheme, you're in a registered fund. And that confusion will clear. Food for thought, even as we progress. So anything or any scheme that is called unregistered. That is not a pension scheme. It's not a pension arrangement. It's just another scheme, which is an investment. So that we forget this confusion within us. All right? Those are just my thoughts. Now, gratuity. The exemption of gratuity. I think this is just for noting. I think there was reference to public schemes. So it brought confusion about what about the private pension schemes. So that is something, even as we put our house in order, that needs to be clarified. I believe private schemes are part of that exemption, but the way it came, it just referred to public scheme. The other one was on the tax exemption, still referred to annuities. We want to believe even income drawdown is part of it, and that's how we understand it as an industry, just for cleaning the mess. So those are just my few pointers. Like I said, every day is a learning day. Let's keep improving our industry because the funds are growing. Thank you very much.
Thank you for your clarifications. My name is George Okioma from CPF. Yes, just two clarifications. Please confirm the taxation of the post-retirement medical fund on retirement and what tax brackets, if any, are applicable both at retirement and early living. Two, you indicated that you are still doing integrations with RBA on the issue of harmonizing that one-off registration to ensure that the registration with RBA suffices. Is it hard for you guys to just issue even a clarification or a letter to the industry that that's what you are doing, just to make sure that there is a commitment from KRA to comply with that requirement, such that as you know, the way investments are done, you would require that you have that tax exemption and that the RBA certificate suffices. You just mentioned that, and I'm sure that will sort most of the things even as you integrate your systems with RBA. Thank you.
Okay. So, yeah, good afternoon. Thank you, Isaac, for the presentation. This is Dennis Deep from Old Mutual. I need a clarification on the transfer of gratuities, and maybe I'll give you a quick figure so that I get a more straight answer. If I have accumulated gratuities over the years of maybe 3 years, are you saying that I can transfer 360,000 as tax exempt per annum? So if I accumulate 360 from the year 2022, 2023, 2024, and then the year I want to transfer to a pension scheme or a registered retirement benefit scheme, how much will be exempt if I am paying today? That is 360 times 3. I believe that will come to around 1080 or something like that. Thank you.
Okay, thank you. And Naomi?
Thank you, Isaac, for the very good presentation. My name is Naomi from RBA, but I'm asking for a friend. And, and thank you for inviting us to the men's conference. Now, that's on a light note. I just have, I think, maybe 2 clarifications. There's a confusion I'm hearing in the room in terms of the tax exemption. If the maximum tax exempt is 30,000 at the contribution stage, and the NSSF Act has said their contribution are tax exempt. So I think administrators here could be applying 2 different methods. So there are those who are exempting the 30,000 from the pay slip plus the NSSF contribution. So then the total becomes 3420. But then there are those who are taking the 30,000, reducing it by the NSSF contribution, which is that, let's say 4320, and then the balance is what they give to the employee as the tax exemption. You get the 2 scenarios. So which is the applicable scenario? Because I think in the room what I'm sensing, people are applying 2 different methods. So kindly, let's have that clarification. Isaac, I'm clear on the 2? All right, and then the second bit, just maybe to to simplify it, the corporation tax issue. If today, maybe you can respond as Isaac, then you'll tell us KRA's position. If today, KRA obtained orders to auction maybe a property that I owe KRA taxes, you go and get court orders from wherever, whether the court or whichever, and I don't get a stay order, will you still recover that property? Isaac, will you still recover that property? Second question. Just to break it home, Benkiku are the people who got this order from the tribunal. Are they one of the recipients of the letters that you sent? And if you can't answer that, how will KRA treat Benkiku? Assuming all these other schemes don't exist. They didn't go to court anyway, so leave them alone. Let's go to Benkiku. They went to court, they obtained a court order. How are you expecting Benkiku tomorrow to behave in terms of that corporation tax? Now, if the way you are going to treat them is that treatment, can it be replicated across, or it is specifically to Benkiku? And as I said, I'm asking for a friend. Thank you.
Okay.
Okay. My name is Mary Gitao, and I work for Minet Financial Services. I would like to ask a question from the slide on non-residents being paid pension, but I would like to twist that slide to non-residents or residents working outside the country. I'll give a scenario. There's a company in Kenya who has a subsidiary company outside the country, and he has both Kenyans and non-Kenyans working for that organization. But they'd wish to provide a pension benefit to those employees. Tax-wise, I would like to hear how to treat that, or those employees outside the country, during contribution, and then also at the point they access, since that service is not offered within the country. Thank you.
So let's take those 5 questions, and I'm also guided on time. So any other questions after these are answered? So we'll take those, and then we shall move on with our program. Over to you.
Sorry, good afternoon once more. In a meeting like this one, we learn so many things at the same time. One of them is corporate governance. We are from KRA, representing KRA. I did ask earlier on, and my question was very deliberate. I did ask you, just by show of hands, how many of you received the letters? And I think one of you has explained that they received a letter from one station. Did I hear that? Did somebody say that? It would be therefore very wrong for us to tell you here that we are ruling it out that that letter is not right or wrong or right. That's why we told you we will get proper communication on that. Because we do not want to, tomorrow, breaking news this afternoon, KRA has ruled out that those who have received the letter, that was a wrong communication. Did you get my point? So that is why, as people who also do corporate governance, when you come to a scenario like this one, when we give you that answer, take it very positively. And that's why I clarified that in the unlikely event that you received it, it's very simple in life. If you received something, respond. Did we get that? Yes. And that is what makes you safer. Because I don't want to leave this room, say, some 2 guys came, plus the CG's representative, and that's beyond our pay grade. Did you get that? Is that okay up to that point? Thank you. So I think we can conclude that matter at that point so that nobody says that there'll be any clarification later. We agree to that point. And the gentleman here, I think you spoke very well, and we are noting them down. And you also remember and recall that the PS did indicate that there's a meeting which is coming up. Is it next week? Yeah, first of, oh, no. Oh, first week, not 1st of May. I thought 1st of May is a holiday. First week of May. So that's why I said in the beginning that when we're in a meeting like this one, some of the things that we are not able to respond to you on the spot, bring them as proposals. Tunaelewana vizuri? Are we okay up to that point? This one. Somebody said that they're seeing it for the first time. Is it true? Yes. Where are the finance people in the house? So how have you been giving us taxes? How have you been paying? How have you been calculating? Huh? This is what you've been doing for payee. Is that true? So you've been seeing it. But not on? I think he clarified. He did clarify when this is applicable. Yeah, good students, so in a class like this one, get to know what did the teacher say. He did clarify when this is applicable. He said that this is applicable when what happens? When you have withdrawn, but you've not met the pension requirements. Tunaelewana vizuri? So have we seen it? So are we going home knowing that this is what we are supposed to use? Thank you. By the way, you can come to KRA school just in case you're still missing something. We will train you so that we get things right. All right, up to that point? Yeah, you cannot harass my young man like this all this time. Yeah, so by the way, is it clear up to this point? Are we okay? You're saying no. Okay, for example, gentlemen, sorry. Which is your tax station? Which tax station do you go to? Tax service office, which one? You go to Upper Hill, you go to Times Tower, you go to Mombasa Road? None of the above. Also, you don't pay taxes. These are the kind of people I came to look for here as well. You know, us as KRA, in a meeting like this one, we also have to recruit taxpayers. But what I meant to say on a light note is that, by the way, KRA officers are paid so that they guide you on all tax perspectives. Tuko pamoja up to that point. And by the way, I'm in charge of stakeholder engagement. That's why I'm here. So just in case you have any doubt, please come to our offices or just send an email. We have emails that we'll respond to, and our team will respond to you. And as always the case, we have to clarify this all the time. Because we know most Kenyans have got this habit of being tempted all the time. I've clarified to all schools I've gone to that KRA officers are paid very well not to be tempted. That is part of our mandate in terms of the workforce core values. So please, also be our ambassadors. We know that some of you, because of some little monies that you have, you tempt our officers and tell them, let's do this. It's illegal. It's illegal, and for the last 35 years of my work there, I've seen so many people go home. I may be joining them soon, but those ones went before 50. And you realize that before 50, something happens. Did we say that? Yeah, so please pass our good message. That's all we need. Last but not least, Isaac, you want to respond to the others? Yeah. Any other question before I go? Is it clearer? Thank you. Okay, let him respond first.
Okay, now there's a question by Mary Gitao about an employer who has Kenyans and non-Kenyans working for the same organization. Now, on the aspect of determining whether the income or the pension income is taxable here in Kenya, two conditions. One, if you've offered the services here and you're contributing to a pension scheme, I'm just giving scenarios that you offer the services here, you're contributing to a scheme here or a scheme outside, then that pension income is taxable here because the services were rendered here. Number two, if somebody is a non-resident and is contributing to a scheme that is registered here. So number one is about where services were offered. Number two, where the scheme is registered. If the scheme is registered here, then that income, that pension income is deemed to have been earned here in Kenya. Hope that clarifies. Okay, then Naomi, the aspect of the aspect of a court injunction. The issue is here, let me just come out very clearly on this particular matter. You know, the commissioner, since the ruling was issued in August last year, I don't think anyone has received an assessment, isn't it? Even in December, did you get any assessment on installment taxes? Perhaps there were some, there were none. And, the commissioner actually did, abide by that ruling. Perhaps, this is what the law says, and, we really have no basis on charging corporation tax. But as I indicated earlier, I wouldn't want to respond verbally to what people have received a written communication. You'd rather respond to that written communication. But the point is, the TAT ruled. That's what you captured in the presentation. That is the position of the TAT. Number two, there's no stay order. We agree. There's no stay order on that particular matter. Number three, we said there are considerations, there are discussions to perhaps lodge a late appeal on that particular item because the commissioner still feels that he still has a case. So basically, hope that clarifies the issue here. Yeah. Okay. Then Dennis of Old Mutual, transfer of gratuity is, is 360 per annum. So for example, if you're talking about 3 years, it's 360 times 3. That will be exempt. So the 360 that is exempt to a scheme, that you're transferring to a scheme is per year. Now, however, if you've already enjoyed a deduction, that 360 not be available. For example, an employee has already enjoyed deduction on his salary and is now transferring gratuity over and above the salary. Perhaps maybe what will be available will be any unutilized deduction. Hope that clarifies. Okay. Then CPF, sorry, I didn't get the name of CPF. You said George, yeah, George of CPF. Integration, yeah, it's important that we communicate to taxpayers what is happening. That's what we're talking about. Post-implementation, what is KRA doing in actualizing the amendments that came through? Yeah, so and one of them is the aspect of registration. And I think schemes that already have exemption certificates, I don't think you have a reason to worry for now because that integration may affect now schemes that are now being registered. And I think that we should have done even like yesterday, we need to have integrated. So I agree, we need to inform taxpayers of what the commissioner is doing. Then Daniel of Minet, that we need a common position before we leave. We promised that you leave as a after all, taxpayers should be treated equally, isn't it? We shouldn't have a taxpayer, it's the same tax law, somebody is acting in a different way. Like for example, some people have said they've not seen this, and yet they've been computing tax on pay as you earn and so on and so forth. So what we are saying is yes, we should live in here with a common position. After all, we are talking about the same income, the same kind of taxpayer. We're talking about the same contributions from the scheme and so on and so forth. So I agree with you. Then the aspect of unregistered and registered, I think we clarified that now the law as it is, I think it's technically it's done away with the aspect of unregistered. I think it was just for purposes of the presentation here. But now we no longer have I agree that if it's a scheme, you cannot have an unregistered scheme. That's not a scheme because it becomes a scheme after you've been registered, isn't it? And what you're just saying that upon that registration, then you qualify automatically for exemption. So the aspect is how do you implement this automatic exemption? That's where we are. That's where we currently are, automatic implementation. Then I think I captured the aspect of drawdown in as long as you're being paid from a scheme, be it an annuity, be it a drawdown, and so on and so forth, then it qualifies for exemption. And we clarified that gratuity, the only gratuity that qualifies for exemption is that one being paid from the consolidated fund. If it's being paid from a private scheme, then it does not qualify. And as members have said, it appears discriminatory, and I want to believe that is being addressed, through the law. So perhaps I think they allow me to stop at that point. Thank you so much. Asante.
Wonderful, wonderful. Let's give him a round of applause. He's done well. Both himself, Isaac, Julius, and Betty from the Kenya Revenue Authority. Another round of applause for that. So ladies and gentlemen, we are coming to the tail end of our program. And to close our session today is none other than Mr. Jackson Guthu, the Director of Supervision, RBA, to give closing remarks to this session. Welcome, Jackson.
Thank you. Thank you so much, John. Good afternoon. I would like to appreciate the good work we have done today
I'm excited on behalf of the authority. I know CEO used to say, let's convene this meeting for the industry. And we had agreed to do this. But I didn't know that to be so successful. Let's appreciate ourselves. This forum initially had agreed that to discuss issues concerning the tax amendments. We also thought that it's good to bring the PS so that it can interact with the pension industry captains who are causing the growth in the industry. And we want to appreciate the PS in absentia for gracing this occasion. I think it was a good interaction. And it shows a commitment of the government in terms of appreciating what the pension industry can do to this country. As is mentioned, we are at almost 14% of the GDP, and we are getting better. So we really appreciate the PS. We also want to appreciate all the participants. We have about 31 registered administrators. At one point, we had to reduce the numbers because this room could not accommodate us, and we had to restrict the numbers. CEO, what it means for us is that we need to have more meetings with the industry stakeholders. It is here. We have the chairman is here. We have 4 directors here. I think we can commit because we are paid from the industry. We continue holding these forums so that we continue sharing information to ensure compliance is achieved in good time. I would like to thank you, all the participants, the presentations from the industry, Wafuba you did on behalf of the APTAC, ARBS, and FMA Buru. It means that you are working together. And I believe that working together can help us achieve our targets and also our strategic target of getting to 3.4 trillion by 2029. Allow me to appreciate all the administrators, both internal and external. You know, we have a Retirement Benefits Act. We also have the regulations. But the true implementers of this are the administrators. And that's why we truly value you. You're the same people who go out and looking for schemes to register. As you do your business, to grow your business, so you are key partners, and we expect that whatever you have learned today, you're going to share with your colleagues, and also the level of compliance will also go up. I think the discussion with KRA, there was no better person to put it across. Thank you, KRA, for finding time to come and share with your people, the taxpayers, yeah, as members. And now from the discussion, maybe the schemes will no longer be taxpayers. We also, every submission that was made,
and lunch will be at the deck, pool, bar, and lounge. That is by the pool side. So you'll have to go up one floor through the elevator or the staircase opposite the washrooms, and then walk outside, and that's where lunch will be served. As you leave this room, please collect your meal card by the door. They are going to be issued by the ladies who are registering you there. We started off with a word of prayer, and we also want to close with a word of prayer. Therefore, Elizabeth, please come forward and close for us with a word of prayer.
Thank you, John, once again. I think we can again kindly stand. And let us pray in the name of the Father, and of the Son, and of the Holy Spirit. Amen. Lord, we thank you for the sessions that we've had. We thank you for the deliberations we've had. Dear Lord, where there are uncertainties, where there are areas that we need to clarify, may they be clarified. We pray this. Dear Lord, we also want to pray for the food that we're going to have. We pray that you may bless it as it is from thy bounty, through Christ our Lord. Amen. And we end by saying the grace. May the grace of our Lord Jesus Christ and the love of God and the fellowship of the Holy Spirit be with us now and forevermore. Amen. In the name of the Father, of the Son, and of the Holy Spirit. Amen.
Thank you. You're welcome for lunch.
savings too soon reduces the income you will have when you retire, leaving your future less secure. Have you thought about the lifestyle or income you want to retire with? The Many workers access their retirement benefits when switching jobs, unaware of the impact it has on their future. Taking out your retirement savings too soon reduces the income you will have when you retire, leaving your future less secure. Have you thought about the lifestyle or income you want to retire with? The earlier you start saving, the better. And the more you save, the more secure your future will be. Increase your savings today and live your golden years the way you've always dreamed. For more information, visit our website www.rba.go.ke, call our toll-free line 0800-720-300 or email info@rba.go.ke. Secure your future. Secure your peace of mind. RBA, safeguarding your retirement benefits. Many workers access their retirement benefits when switching jobs, unaware of the impact it has on their future. Taking out your retirement savings too soon reduces the income you will have when you retire, leaving your future less secure. Have you thought about the lifestyle or income you want to retire with? The earlier you start saving, the better. And the more you save, the more secure your future will be. Increase your savings today and live your golden years the way you've always dreamed. For more information, visit our website www.rba.go.ke, call our toll-free line 0800-720-300 or email info@rba.go.ke. Secure your future. Secure your peace of mind. RBA, safeguarding your retirement benefit.
Do you have a complaint, or is something just not adding up with your pension scheme? It's easy to file a complaint directly with the Retirement Benefits Authority, and it's absolutely free. Just visit www.complaints.rba.go.ke and follow the prompts to file your complaint. RBA will acknowledge your complaint within 7 working days. Your complaint will be reviewed and addressed within 30 working days. Your time and peace of mind are important, and anyone dissatisfied with a decision of RBA can appeal to the Independent Retirement Benefits Appeals Tribunal. RBA is here to listen and resolve your complaint promptly, because your retirement should be stress-free. For more information, visit our website www.rba.go.ke, call our toll-free line 0800-720-300 or email info@rba.go.ke. Secure your future. Secure your peace of mind. RBA, safeguarding your retirement benefits.